Hi, I'm Erik Ogard, CIO of the Wealth Plan Group. There's been a lot of discussion about the Mag 7, the so-called Magnificent Seven, the largest tech companies that are beneficiaries of the AI movement, with a lot of these companies producing phenomenal earnings and revenue growth, and also being dominant return drivers within markets. And in fact, if you haven't had exposure to these Mag 7, it's been incredibly difficult, if not impossible, to beat broader market indexes like the S&P. We've talked about this in the past. Many other commentators have written and talked about this, so it's nothing new, but I think it's worth repeating because we're seeing some changes in the market. So we want to kind of help people see where we are in the cycle and gain an understanding of where we might be going with respect to these Mag 7 and the broader market. We note, and we have a chart here showing the 3 years of returns to the S&P 500 index, the S&P 500 equal weighted index, and the Russell 2000 index. And so what we see over this 3-year period is that particularly in the last year and 3 months or so, the S&P cap-weighted index, the S&P 500, what we all look at every day, is the dominant index. If you look at its returns over the last year and a half relative to the S&P 500 equal weighted index, again, same 500 companies, just one holds them at equal weights. If it's 500 companies, that would be about 20 basis points per position versus cap-weighted. The difference between those two indexes has been absolutely massive. There are implications for active investment management. If you don't own those top names, you've been absolutely left in the dust. And so here's how to think about it, and some people may not think about beating an index in this way, but the reality is these big cap tech names, the Mag 7, compose about 30% or a little bit more of the total capitalization of the S&P 500 index. So 30%. And you know, if you own one of those stocks, but you underweight it relative to its underlying index weight, so like if you own an Nvidia at 5%, every time that stock goes up, you lose to the index. So you actually have to overweight it relative to the index to beat the index in an environment like this. And not many investors have the knowledge of that kind of setup or the fortitude to make that kind of a risky investment at such a large weight. Now, a few weeks back, we did a piece called Pivot Party, and when the Fed indicated that they would likely be lowering rates or cutting rates come fall, the market really changed tenor and shifted direction. We saw small caps leading, and it begs the question, what has happened to the S&P index equally weighted versus that S&P cap weighted, and what's happened to small cap stocks in the last month? What we see is a pretty meaningful reversal, and what we're trying to figure out, is this a pause, is it a reversal, or is it the beginning of a new trend? Of course, we won't know those things until we see a lot more data over the passage of a few months here. Will it go this way for the rest of the year? We don't know, but there's so much distance, especially over 10 years. If you look at 10-year charts and look at the performance of the cap weighted versus the equal weighted, there's this really large delta that's opened up between the indexes over long periods of time. And this is true for growth over value as well. And the way we run money at Wealth Plan, we have a Dividend Aristocrats portfolio where we are emphasizing dividend growth, and the stalwart dividend payers with a strong record of dividend increases over years and never a cut has been a strategy that has stood the test of time. But in this last 18-month period, with the S&P cap-weighted index dominating returns so much, we've seen things, and growth dominating so much, we've seen the dividend aristocrat stocks lag. So we thought, what does this last month look like for these dividend aristocrats growers? So we looked at the dividend aristocrats S&P 500, the large cap dividend growth stocks, and the dividend aristocrats S&P 400, or the small and mid cap dividend growers. And what we find is that along with the Russell 2000, the S&P 400 dividend growers have really snapped back as well, well ahead of the S&P dividend 500. So this tells us that the market is beginning to broaden to include more names. Now, whether this continues on is the million-dollar question. We think it comes down to the broad economy, what the Fed does with rates, and the fundamentals of those companies. The stock market always follows earnings in the long run, so we need these companies to start participating in the earnings growth that we've seen from those Mag 7 over the last year and a half. Right now it looks pretty good, so knock on wood, we think we're entering a period where this broadening is going to continue. And let's face it, the S&P 500 index with those tech names has a very high valuation right now, and there are just better risk-reward trades in the market, in our view, moving down cap and moving towards some of these more conservative dividend growth type companies. So until next time, we thank you for your time and look forward to catching up soon.